Welcome back to our video series on the US tax reform. Today we would like to focus on the BEAT tax. Elisa, during the campaign of Donald Trump, there was a lot of talk about the border tax, which he wanted to implement, which obviously would have been a huge impact on investments from foreign companies to the US. It got quiet about that, and then it was a talk about an excise tax, which is kind of similar. Now that we have the new regulations, we know that is off the table, but there are still some tricky parts in this directions which are considered the BEAT tax. Mm-hmm. So could you maybe elaborate a little bit on the BEAT tax?
Sure, of course. So you're referring to the base erosion and anti-abuse tax.
Thank you very much.
You're welcome. Which we love our acronyms in tax here in the U.S., as you know. And so we've, of course, named that the BEAT, which I think is kind of funny because it just thinks about like beating down companies or something like that. But anyway, I digress about that. So the BEAT tax is a new tax that is effective in 2018. And one of the reasons this came into play is that in another aspect of the new law, corporate shareholders can now bring back their earnings from abroad tax-free. And so, of course, that sort of erodes the U.S. tax base because now we're not getting the income from taxing, profits from abroad when they're brought back to the U.S. So what Congress did was to create a mechanism to deter U.S. companies from eroding the U.S. tax base by paying tax-deductible expenses to, for example, in our case, the German parent, right? And then, of course, having the German parent route that money right back into the U.S. or maybe paying it to an affiliate and then bringing the money back into the U.S. tax-free. So Congress was trying to avoid that, and so now we have this new BEAT tax. But basically, the BEAT tax is really like an alternative minimum tax, and which we previously had as well, another mechanism, very complicated mechanism. And this is similar to that, and that tax has actually been repealed. So in essence, this BEAT tax kind of replaces the alternative minimum tax.
Okay, very interesting. But I mean, as a U.S. company, how do we know that the BEAT tax specifically applies to the companies?
So the BEAT applies to a U.S. corporation or a branch of a foreign corporation, and I think it's important to know that for our German Mittelstand because, as you well know, we often have clients that operate through a branch in the U.S., right? Correct. And not through a corporation or a partnership here in the U.S. So if those companies have a 3-year average annual gross receipts of 500 million or more.
500 million?
Yes, pretty high.
Pretty high.
And a base erosion percentage of at least 3%, then they would be subject to the BEAT. For most of our German Mittelstand companies, we don't think this will be applicable because of the 500 million threshold. But I do think companies should be careful in determining that threshold amount because it is done on an affiliated group basis. Mm-hmm. However, one of the positive things here is that foreign affiliates that do not have gross receipts that are generating effectively connected income in the U.S. are not included in that calculation. So that's going to be a very helpful aspect. Okay,
interesting. So, I mean, you're saying that probably for most of our clients, the BEAT tax is not necessarily applicable. However, let's say I find out that the BEAT tax is applicable for my entity in the US. I mean, how does it work?
So first of all, assuming again that we are past that threshold like we talked about, our companies are going to have to go through and actually identify all of their base erosion payments, which are essentially all of your tax deductible payments. And again, and in tax, nothing is ever simple, and in this case, it's not simple either. And so you're looking at payments to all of your related parties, and for this purpose, related parties is defined in a really broad manner.
But let me come back to that, Elisa. Most of our clients purchase a lot of trading goods, raw materials, equipment from the parent company in Germany. So is the purchase of those goods also considered under the BEAT tax?
That's an excellent question. I'm glad you brought that up. So for inventory purchases, they are actually not considered a base erosion payment. And that's because our Joint Committee on Taxation, they view inventory purchases as a reduction of revenue rather than a deduction. So that's a positive thing. Those purchases are not considered a base erosion payment. But purchases of fixed assets or equipment, machinery, any of those things, those are considered base erosion payments, unfortunately. And the only thing I think that is helpful in that regard is that when you're actually looking at the base erosion amount that would factor into your calculation, you're taking into account the depreciation expense for the year only, not the entire purchase price. Okay. Which is good. But that is assuming you're not taking advantage of this new full expensing provision that we have. So if you're taking advantage of that, then of course you have depreciated all of it, the entire purchase price, right? And so then you would have the entire amount would be included in your base erosion payment.
So you really have to look at the full picture.
Absolutely.
Right? But a good amount of our clients have also kind of different contracts, and they not just purchase the inventory, they have, for example, a lump sum contract, so meaning the purchase of the machine, but also including the services and maintenance. So what is with those contracts?
Well, I think right now that is unclear, and until we get final regulations, we're not going to know the answer to that with certainty. But our initial thinking is that companies are going to be required to bifurcate those contracts. Service payments that are specifically just to reimburse expenses are not considered a base erosion payment, which is good, but any service with a markup is. So if we have a contract that includes both, let's say, a machine and then the installation component and then maybe a warranty or any of those things, then I think a company is going to have to actually segregate those out.
Oh, that sounds like a lot of pain.
Yes.
Yeah. So now that I know my payments, what is coming next?
Okay, so the next thing, again, once you have identified all of your base erosion payments, and again, just as a reminder, assuming we're over the 500 million threshold, we've exceeded that 3%, percentage. That's actually what we're about to calculate. We identify all of our payments, and then you take those payments with some exceptions, of course, because we have to have exceptions to everything in our law.
Sure.
And then you divide that by your total tax deductible payments with some more exceptions, of course. And then you see what that percentage is, and if it's 3% or more, or at least 3% or more, then we will be subject to the BEAT tax, or the company's going to be subject to the BEAT tax. And at that point, you get that far, you keep going, and you actually calculate your BEAT liability. Yeah. And the liability for 2018 will be 5% of your modified taxable income. In future years, it's going to go higher than that, but 5% in 2018. I think then that amount is compared to your regular tax liability, and you pay the greater of the two. I think for a lot of our German Mittelstand clients, though, they're going to find that they're going to go through all this work to, in the end, not actually owe the tax.
Okay. But is there still anything else the companies need to be aware of in regards to the BEAT tax?
Yeah, actually there is. So the new law adds this additional reporting related to the BEAT. And we don't know yet what the specifics of that reporting are going to be, but we do know that the law has said that the reporting is going to require all the information necessary to calculate the BEAT. So all the things we've been talking about, your base erosion payments, what your receipts are, presumably would all be required for this reporting. And it looks like they're going to add this reporting to an existing form where we already have that reports related party transactions. And one little tiny piece of the law that they slipped in, which I don't think companies have been focused on, is that this particular form carries a penalty of what used to be $10,000 per form for late or non-filing, and is now gone to $25,000 per form for late or non-filing. So I think that's a significant thing to be worried about.
No, absolutely. That sounds like it. So pretty much it's a kind of a trap for companies which are not aware of the BEAT tax or aware of the documentation, right?
Exactly.
Yeah, please be aware that we have more videos out there where we actually go into more details on the other topics of the US tax reform.